welcome to the Bourse Report. I am Marjorie Seaver, Manager of Equities at Bourse Securities, and I'll be holding Officer Road today, who is currently out. Today, we will be taking a look at the fixed income market, both on the local and international space. And we'll start off this morning taking a look at interest rates and inflation. So firstly, let's take a look at inflation in the market, and we will take a look at headline inflation ended August up 40 basis points year on year from 70 basis points at the end of December. Core inflation relatively flat year on year, up 0.1%, up as opposed to December of 1.2%. And on food inflation, which has been a little sticky, ended August up 1.5% year on year, down from 1.1% in December 2023. On the yield curve, we take a look at the TT yield curve, and we did see an increase in the yields on the shorter end of the yield curve at 1 year yields, jumped from 1.79% at the end of December to 3.68%. At the 5-year end of the curve, yields jumped to 4.75% from 4.22% at the end of December. And in the longer end of the curve, yields fell to 7.5% from 7.66%. And we'll take a quick look at excess reserves in the system. And this is indicative of liquidity in the system. At the end of July this year, we saw excess reserves fell to 3.5 billion from 5.89 billion at the end of December. And the central bank did intervene in the market, and they did cut the reserve requirement ratio from 14% to 10%. The last time that was done was in 2020, when the rate was cut from 17% to 14%. And this cut in the reserve requirement ratio led to improvement in reserves in the system. And at the end of September, we saw a jump in the commercial bank excess reserves to 6.48 billion. And with the tightening of liquidity, that would have influenced the yields on the short term, where we saw it jumped in the previous slide. So hopefully with the improvement in excess reserves, we should see a lowering of the short-term yields in the local end market. In terms of our outlook on the bond market, we continue to expect moderating inflation. And granted, we don't see any political risk, geopolitical risk in the external environment. We should see moderating inflation, and with that, we should see stable interest rates. Our repo rate continues to be maintained at 3.5%, and we do expect in terms of the short-term yields to fall with the improvement in excess liquidity in the system. And in terms of our bond offering, we continue to expect limited bond issuances in the market, and availability to investors will be limited in the bond space. Let's take a quick look at international inflation data in the US market. And we have seen a fall in inflation data over the last year. The CPI has fallen to 2.4% at the end of September from 3.4% in December. And the PCE, another indicator of inflation in the US market, fall to 2.2% from 2.7% at the end of December. And targeted inflation in the US space is 2% by the Fed, and we see Fed data, inflation data falling to close to these levels. And with the fall in inflation in the US market, we did see the Fed finally cut interest rates. There was a cut of 50 basis points in September, the first time that has been done since March 2020. And this follows an over 5% increase in Fed rate from the beginning of March 2022 to July of 2023. So we have seen a cut in interest rates, and we do expect another 50 basis points cut in this year, and market outlook is for another at least 1% cut in interest rate next year in the US market. And how has this impacted on the yield curve? We have seen a dip in short-term yields. At the end of October last year, yields were at 5.04% for the 2-year Treasury, and it's down to 3.93 at the end of October currently. In terms of the 5-year yields, the 5-year yield fell from 4.65 last year to current 3.84, and then the longer end of the curve at the 30-year Treasury yields, the yields fell from 4.78 to 4.3%. How has this impacted on USD paper issued by TT bond issuers? In the Trinidad and Tobago paper of 2026, we saw yields currently at 4.9%, as opposed to the 52-week high of 6.3% and the 52-week low of 4.2%. And the NGC 2036 paper current yields are at 6.6%. The 52-week high was 7.1%, and the 52-week low at 6.3%. So we've seen a drift in yields at the lower end of the 52-week spectrum. And this, as we've seen interest rate fall in the US space, bond prices have improved. In terms of our outlook for the international bond market, we continue to expect, again, moderated inflation if there are no geopolitical matters arising. With moderating inflation, we expect decline in interest rates in the US space, and other central banks have continued to cut rates as well. We saw the ECB cut rate earlier this month as well. And with the cut in rates, we expect some stabilization in bond volatility, with prices should be falling, yields should be falling, and prices improvement, And with falling interest rates, we expect the issue of new paper to be at lower rates and refinancing at lower rates. So there should be some improvement in the stable quality of credit issuers. In terms of investor consideration in the fixed income space, on the lower end of the risk tolerance, in terms of investment opportunities and short-term maturities of less than 3 years in repo and investment income funds, the availabilities both in the TTD space and the USD space. To the moderate investor, investment opportunities and investment grade bonds of maturity 4 to 8 years. The availability is more in the USD space, limited operate on the TTD space, and the higher risk tolerance investor who looks for speculative grade bonds of longer maturities. Again, the opportunities lie in the USD space and very limited opportunities in the TTD space. If you are interested in investing in these instruments, please feel free to call us at Bourse 226-8773. Visit our website, boursinvestment.com, or email us at bourse.financial.com. Thank you for joining us today, and do have a wonderful investment week.